When I look at what is happening now, I do not see a simple oil story. I see a change in power. That is what most people miss. They see the United Arab Emirates leaving OPEC. They see the price of oil moving above $100. They see gasoline prices rising. They see politicians talking about Cuba, carriers, sanctions, ceasefires, and swap lines. Then they treat those things as separate events. That is not how systems work. In a system, one event is usually a symptom. The real question is what pressure is underneath it. And when I look at this situation, the pressure underneath it is the same pressure that has been building for many years. The world is testing the dollar system. The oil producers are testing the dollar system. China is testing the dollar system. The bond market is testing the dollar system. And the United States is discovering that the power to print money is not the same thing as the power to control reality. That is the story. The UAE was one of the founding members of OPEC. It sat inside that cartel for decades. It helped participate in a system where oil producers managed supply. Oil was priced in dollars, and those dollars flowed back into American financial assets. Now the UAE says it is leaving OPEC and OPEC Plus on the surface. That sounds like a decision about production quotas. It says it wants more flexibility. It says it wants to meet changing demand. That explanation is not wrong, but it is incomplete. In my experience, whenever a country says it wants flexibility, you should ask what constraint it is trying to escape. The constraint here is not only OPEC. The constraint is the dollar system itself. Just before the UAE announced that it was leaving OPEC, it warned that if it ran low on dollars during the Iran war, it might be forced to use yuan or other currencies. That sentence is extremely important. It means one of America's close allies was effectively saying, if the existing dollar structure does not give us the liquidity we need, we will begin to work around it. That is not a small warning. It is the kind of warning that tells you the system is negotiating in real time. The United States response was also revealing. The Treasury Secretary talked about dollar swap lines for Gulf allies. He explained that swap lines from the Federal Reserve or Treasury could maintain order in dollar funding markets and prevent the disorderly sale of us assets. That phrase matters. Prevent the disorderly sale of us assets. When I hear that, I do not hear reassurance. I hear leverage. If a Gulf state holds enough American assets that selling them could destabilize us markets, then the relationship is no longer one-sided. For decades, Americans were taught to think of the Gulf states as dependent on us protection. That is true in one sense, but in another sense, the United States is also dependent on their willingness to hold dollars, hold treasuries, and keep recycling energy wealth back into the American financial system. That is what makes this moment different. It is not simply that oil prices are high, it is that the countries that sell the oil are asking whether they still want to accept paper promises on the same old terms. To understand why this matters, you have to go back to the beginning of the modern dollar system. In 1971, President Nixon closed the gold window. Before that, the US dollar still had a formal connection to gold. After that, the dollar was no longer redeemable for gold. It became a pure fiat currency, backed not by metal, but by trust, power, military strength, financial depth, and the belief that the United States would remain the center of the world order. That created a serious problem. If you are an oil producer and you own a finite resource, why would you sell that finite resource for a currency that can be created in infinite quantities? That is not a moral question. It is a practical question. Oil is real. You can burn it, you can refine it, you can move ships, trucks, airplanes, factories, farms, and armies with it. But paper money after 1971 depended on confidence. The United States needed a new anchor. That anchor became oil. In 1974, Henry Kissinger made the critical arrangement with Saudi Arabia. The broad structure was simple. Saudi Arabia would price oil in dollars. Those oil dollars would be recycled into U.S. Treasury bonds in return. The United States would provide military protection, weapons, and political support. That was the petrodollar system. It was elegant in the way powerful systems often are. Every country needed oil. If oil was priced in dollars, every country needed dollars. If every country needed dollars, the United States could run larger deficits, borrow more easily, import more cheaply, and keep its financial markets at the center of global savings. The dollar was no longer backed by gold. It was backed by oil demand and the structure around that oil demand. OPEC became part of that structure. OPEC managed oil supply. It helped stabilize and influence oil prices. It helped create a world where oil producers could receive dollars and then send many of those dollars back into U.S. financial assets. That system benefited the United States enormously. It also benefited Gulf monarchies because they received protection and access to the deepest financial markets in the world. But every system works until the incentives change. And now the incentives are changing for many years. The world accepted the dollar because the dollar system delivered liquidity, safety, and scale. But when a reserve currency is also used as a weapon, other countries begin to ask a dangerous question. What happens if that weapon is one day pointed at us? That question became much more important after Russia's reserves were frozen in 2022. You may agree or disagree with the reason. That is not the point. The point is that every central bank in the world watched the same event and learned the same lesson. If your reserves are held in dollars or treasuries and the United States decides you are on the wrong side of its policy, those reserves may not be as safe as you thought. That changed the psychology of the system. Once trust changes, flows change, and when flows change, the monetary order changes. That is why gold has been moving back into the center of the story. Central banks are conservative institutions. They do not move because of internet excitement or short-term trading. When they buy gold aggressively, they are making a statement about trust, counterparty risk, and the desire to own something that does not depend on another government. Promise, gold has no board of directors. It has no central bank. It has no sanction committee. It is not someone else's liability. That is why countries are buying it. At the same time, China has been building alternative plumbing. It has yuan clearing banks in major financial centers. It has relationships with commodity producers. It has been building payment systems outside the full control of the Western order. It has been buying real assets, copper mines, ports, processing capacity, rare earth supply chains, and industrial capacity. The United States built a magnificent financial system. China built a lot of the physical system in a world of peace. Those systems can coexist in a world of conflict. The country that makes the things can have leverage over the country that prints the claims. That is why the UAE situation matters so much. The timeline itself tells a story. The UAE deepens its relationship with China. It signs trade and investment deals. It signals that it may use yuan or other currencies if dollar access becomes constrained. The United States discusses swap lines. Then the UAE leaves OPEC. That is not random. That is negotiation when one side has dollars and the other side has oil assets. And alternatives, each side tests how much leverage it has. The Iran war made the test sharper. The Strait of Hormuz is not a normal shipping lane. It is one of the most important energy choke points in the world. A very large share of the world's oil and gas moves through it. If that route is closed or heavily restricted, the economic model of Gulf exporters comes under pressure almost immediately. Saudi Arabia, the UAE, Kuwait, Qatar, Iraq, and others depend on getting energy to market. If the flow is restricted, the revenue drops. If the revenue drops but the domestic spending obligations remain, they need dollars. If they need dollars and they cannot earn enough of them through oil exports, they have several choices. They can borrow, they can draw reserves, they can ask for swap lines, or they can sell us assets. That is where the pressure becomes systemic. A country that holds a large amount of us assets does not need to threaten loudly. It only needs to say, we may need liquidity. The market understands what that means. The Treasury understands what that means. The Federal Reserve understands what that means. If those assets are sold in size, yields can rise. If yields rise too much, the U.S. government's borrowing problem becomes more difficult. If borrowing becomes more difficult, financial conditions tighten. If financial conditions tighten during an energy shock, the entire system becomes fragile. This is how one geopolitical choke point can become a monetary event. And that is why I do not treat this as a headline. I treat it as a chain reaction. Saudi Arabia is a good example. Before the war, it already needed a relatively high oil price to cover its government spending. If the volume of oil exports falls, it may need a much higher oil price to generate the same revenue. But if the paper oil price is being kept below what the physical pressure might imply, then the producer's revenue problem becomes worse. That creates the need for dollars, and the need for dollars creates leverage for whoever can provide them. In the old world, the United States provided protection and dollars, and the Gulf provided oil and recycled the proceeds into U.S. debt. In the new world, the Gulf can say, we still want dollars, but we also have options. China is the most important of those options. China buys energy. China buys commodities. China has manufacturing capacity. China has payment systems. China has yuan. China has gold ambitions. China has the patience to build alternative rails slowly and then use them when the existing system becomes unstable. That does not mean the dollar disappears tomorrow. That is a common mistake people make. They confuse decline with collapse. The dollar can remain the largest reserve currency and still lose its monopoly premium. It can remain the deepest currency and still become less trusted. It can remain central to trade and still face more alternatives. That is usually how reserve currency shifts happen. They do not happen like a light switch, they happen like erosion. A little less dependence here, a little more gold there, a little more yuan settlement, a few more commodity contracts outside the dollar, a few more central banks diversifying, a few more countries realizing that the reserve asset they hold can also be used against them. Then one day people look back and say the system changed slowly, then all at once. That is the pattern. The rare earth story fits into the same pattern. The United States has extraordinary financial power. It has the largest capital markets. It has the global reserve currency. It has the ability to create liquidity on a scale no other country can match. But you cannot fight a war with financial assets alone. You need missiles, interceptors, chips, rare earths, tungsten, industrial supply chains, and manufacturing capacity. China controls a very large share of rare earth mining and an even larger share of processing. That gives it leverage over military production, advanced technology, and critical industrial systems. If the United States needs materials from China to build the weapons that might be used to contain China or its partners, the contradiction becomes obvious. The financial side says America is dominant. The industrial side says the picture is more complicated. That is why this is not just a dollar story, it is a real economy story. For many decades, the United States could print claims, sell debt, import goods, and rely on other countries to hold the dollars. That worked beautifully while everyone believed in the arrangement. But when other countries begin to question the fairness, safety, or durability of that arrangement, they start to accumulate hard assets, build alternative payment channels, and seek more control over their own systems. That is what is happening. Now, the dollar share of global reserves has fallen from the high levels it held 2 decades ago. It is still the largest share, but the trend matters, and the replacement is not simply another paper currency. A major replacement has been gold. That tells you something. Central banks are not only choosing another country's promise. They are choosing an asset with no issuer. That is a very important signal at the same time. Investors are demanding more compensation to hold us debt. When trust is strong and inflation is low, investors accept lower yields. When trust weakens, inflation is sticky, deficits are large, and geopolitical risks rise, investors say, "Pay me more." That is what the bond market does. The bond market is not emotional in the way social media is emotional. It expresses fear and confidence through price. If Treasury yields rise toward levels that make the U.S. fiscal problem more difficult, policymakers feel it immediately. And there is a key level that has been watched closely. When the 10-year Treasury yield approaches a level around 4.4%, the political and financial system begins to react. Military language softens, ceasefires get extended. Pressure rises for stability. That tells you something very important. The bond market is not just responding to policy. It is shaping policy. That happens when debt is very large. When a country has low debt, policymakers have more room. When a country has very high debt and must refinance constantly, bond yields become a political constraint. Every increase in interest rates affects government interest expense, mortgage rates, business borrowing, valuations, and the stability of the financial system. That is why I pay so much attention to bond markets. They tell you where the pain threshold is. And right now, the pain threshold is being tested by energy, war deficits, and distrust in the reserve system. The United States can provide dollar liquidity to Gulf states that can stabilize markets in the short run. It can prevent disorderly sales of treasuries or other U.S. assets. It can keep the plumbing functioning, but liquidity does not solve the physical problem. If Hormuz remains disrupted, oil and fertilizer flows remain at risk. If energy prices rise, inflation pressure rises. If inflation pressure rises, bond investors demand more yield. If bond investors demand more yield, the Treasury market becomes more fragile. If the Treasury market becomes more fragile, the Fed and Treasury face harder choices. That is the dilemma. You can stabilize the financial system with more dollars, but if the real-world shortage persists, those dollars may feed commodity inflation. You can try to suppress yields, but if inflation rises, the bond market resists. You can try to extend a ceasefire. But if the underlying conflict is not resolved, the risk remains. That is why this situation is so important. It is an economic war as much as a military one. Iran understands that the Strait of Hormuz is leverage. China understands that rare earths and manufacturing are leverage. The Gulf states understand that their holdings of US assets are leverage. The United States understands that dollar liquidity and military protection are leverage. When each player has leverage, the system becomes unstable because every move creates a counter move. So how can this end? I see two broad paths, and neither is clean. One path is that Iran breaks or collapses under pressure. If that happens, the geopolitical outcome may look like a victory for some people, but the energy consequence could still be painful. Oil infrastructure may be damaged. Iranian oil may remain offline. Risk premiums may remain elevated. Energy prices can shock the global economy. The other path is that Iran does not break quickly, and the disruption continues long enough to stress global supply chains. In that case, oil, fertilizer, food, and shipping costs can move through the economy in waves that can raise inflation at the exact time the bond market is already sensitive to debt and deficits. Both paths create recession risk. Both paths create inflation risk. Both paths pressure the dollar system. That does not mean you panic. Panic is rarely useful, but it does mean you should stop treating market calm as proof that the risk is gone. Markets often price perfection before they are forced to price reality. Right now, many investors are assuming several things at once. They are assuming the AI productivity boom will continue to support valuations. They are assuming the Iran conflict will not become a long energy crisis. They are assuming the Treasury market will remain functional. They are assuming the dollar will remain the unquestioned center. They are assuming oil and food inflation will not force a major policy change. Maybe those assumptions prove correct. But if even one or two of them prove wrong, the repricing can be severe. That is why I think about portfolios in terms of balance, not prediction. The mistake most investors make is that they want one answer. They want to know whether stocks go up or down. They want to know whether oil spikes or crashes. They want to know whether gold goes higher or lower. They want to know whether the dollar collapses or survives. That is not how I think. I think in probabilities, I think in scenarios, I think in consequences. If I am wrong, what happens? If the world changes faster than I expect, what happens? If policymakers choose the easy, short-term solution and create a bigger long-term problem, what happens? If the bond market forces the issue, what happens? That is why cash matters. Cash gives you flexibility. It lets you respond when markets misprice fear or complacency. That is why gold matters. Gold is not a perfect asset. It does not generate earnings. It can be volatile. But in a world where trust in paper claims is being questioned, it plays a different role. It is a reserve outside the liability structure of another country. That is why energy matters. Energy is the base layer of the economy. If the price of energy changes sharply, everything else changes. That is why I still pay attention to equities. The United States stock market remains one of the deepest, most innovative markets in the world. A decline in the dollar's monopoly does not mean the United States becomes irrelevant. But valuations matter, debt matters. The real economy matters. This is not a time to be ideological. It is a time to be realistic. The US dollar is not going to zero tomorrow. The United States economy is not going to vanish tomorrow. The Treasury market is not going to disappear tomorrow. But systems can weaken long before they break. And the people who understand that weakening early tend to make better decisions than the people who wait for an official announcement. There will be no official announcement that says the petrodollar is over. There will just be more oil settled in other currencies, more central banks buying gold, more Gulf states asking for dollar liquidity, more Chinese commodity arrangements, more pressure on Treasury yields, more political sensitivity to bond market levels, more questions about what the dollar is really backed by, and eventually the world looks different. That is how large cycles work. They begin with small changes that people dismiss, then they become patterns, then they become crises, then they become the new reality. The UAE leaving OPEC may be remembered as one of those signals. Maybe it is not the final break, maybe it is not the dramatic event people expect, but it is a canary in the mine. It tells you that the countries inside the old oil dollar system are no longer as comfortable with the old rules. When the countries that sell the real resources begin to question the paper they receive in exchange, you should pay attention. When the countries that hold the debt begin to ask for liquidity guarantees, you should pay attention. When central banks buy gold instead of adding treasuries the way they used to, you should pay attention. When the bond market starts shaping foreign policy, you should pay attention. And when the market is pricing a clean outcome in a messy world, you should be very careful. My approach in moments like this is not to predict the exact next headline. It is to build resilience. I want liquidity. I want diversification. I want exposure to productive assets. I want protection against currency debasement. I want to avoid being forced to sell at the wrong time. I want to understand where the leverage is in the system before everyone else realizes the same thing. That is what this story is really about. It is not about one OPEC member leaving. It is not about one oil price spike. It is not about one swap line. It is about the slow renegotiation of the global monetary order. The old system was built on a simple deal. You sell oil in dollars, you recycle those dollars into us assets, we protect you. The world uses the dollar because the world needs oil. Now the new system is being negotiated under stress. Who controls the oil? Who controls the shipping lanes? Who controls the rare earths? Who controls the payment rails? Who controls the reserve assets? Who holds the debt? Who can print money? And who still trusts that money when the printing becomes too easy? Those are the questions that matter. Most people will not ask them until after the consequences show up in gas prices, mortgage rates, grocery bills, portfolio losses, or currency weakness. But by then, they will be reacting. I would rather understand the machine before the machine breaks. That is the principle. Watch the oil flows, watch the dollar flows, watch the gold flows, watch the Treasury market, watch what countries do, not what they say. And above all, remember that money is not just paper, and markets are not just prices. They are expressions of trust. When trust shifts, everything eventually reprices.